Hey, hello investors and future investors. Welcome to the channel. For today's video, I'm going to show you two option strategies that can be used if you're interested in making weekly income. So if you're new to options trading or you're trying to get that extra money in order to supplement your regular 9 to 5, then I suggest you pay close attention. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be showing you some strategies that can be used in order for you to make consistent income on a weekly basis. Now, for those of you that are the real investors and you guys stay to the end of the video, I will give you a bonus option strategy that's even better than these two. That being said, for today's video, we're going to be using Mara Holdings, ticker MARA. Now you guys know how we do it on this channel. Let's go ahead and get down and dirty with options. Let's go to trade Mara options in order for us to open up the option chain. Now, for those of you new to options, this area down here is what's known as the option chain. And what that area does is that it gives us enough information in order for us to make an informed decision before getting into any option contract. Now, before we go ahead and get further along into this video, I always require two things from all of my subscribers. Number one is going to be that you always do your own due diligence before getting into any options contract. And number two is always make sure you have an exit strategy before trading options. Okay, so for strategy number one, we're going to make sure it says sell, we're going to make sure it says call, and we're going to choose the very first expiration date because I'm showing you how to make options weekly. So that's going to be March 14th, and that gives us roughly 5 days. I'm also going to show you a trick later on to how you could hack the system to make even more premium. So now we have sell, we have call. We're going to go ahead and we're going to choose our strike price. The strike price I'm going to be using is going to be 17.5. And for that, I have a very high chance of profitability, which is going to be 81%. Now, with the 17.5 strike price and with the 81% chance of profitability right here, I'm going to be receiving what's known as a premium. That premium is going to be 0.32, or in real life, that's going to be $32. Each option contract contains 100 shares. So if you were to multiply 100 shares by 0.32, that should give you a solid $32. This first option contract is known as the covered call option strategy. The covered call option strategy is what I refer to as a win-win option strategy. No matter what you do, you win. There's only one way to lose with the covered call option strategy, and that's if you choose the wrong stock. Now, in order for you to do the covered call option strategy, either of two criteria must be met. Criteria number one, you must be able to own 100 shares of the stock. Criteria number two, if you cannot own 100 shares of the stock, then you are required to at least control 100 shares of the stock. I will show you how to control 100 shares of the stock towards the end of the video. Now, let's say we were to own 100 shares of the stock. We need to buy it for $15.96 per share. So that's going to cost us about $1,596. And this works out perfect, like I said, if you're trading with a small account. So once you acquire this for, like, let's round it up to $1,600, now you go ahead and you sell it at a strike price of $1,750. Now, the whole purpose of the covered call option strategy is for you to make some additional income every single week consistently without taking much risk. Now, this is how this option strategy works out. From expiration date of March 14th, you do not want this share price right here to hit the 17.5. If that happens, then now you're going to be assigned. Assigned means is that now you're going to have to sell your 100 shares that you bought at $15.96 per share. You're now forced to sell it at 17.5. So that's a huge win for you, because let's say it's now going to be 17.50 minus, let's round it off to 16. You're now going to get $1.50 of stock appreciation. The $1.50 once again multiplied by 100 shares is going to give you $150 plus the premium you receive, 0.32, and that's going to be $182. Now, remember, that's only if you're assigned come expiration date. Now, here's the other win. if you're not assigned come expiration date, meaning if this share price does not hit the strike price you chose, then you're totally fine with that as well, because now you get to do the same strategy over and over every single week in order to make consistent premium. And that premium is going to be used in order for you to grow your small account portfolio. Now, this is the covered call option strategy. This can be used. Let's go ahead to another option strategy that can be used if you want to make weekly income. Now, for that, we're going to change the parameters just a tad. So now instead of sell and call, let's go ahead. First of all, let's get out of this. So we're going to go to sell, and now we're going to go to put. This option strategy, now we're going to go ahead and choose our strike price below the current share price. And I'm going to be going with the $15 strike price. You can see strike price here. And now look at my chance of profitability. It's now 73%. Remember the first one, it was around 80%. I'll explain to you why this could be 73% in just a second. But most importantly, once again, once we do this other option strategy, we stand to gain some money again. The money we're going to be receiving this time is going to be 0.39 or $39. This second option strategy is known as the cash secured put. Now, with the cash secured put, you don't need to own any shares. You don't need to control any shares. The criteria that has to be met is that you need to have cash, hence the first word, cash. Now, how much cash do you need? Well, I'm glad you asked. The amount of cash you're going to need is going to be whatever strike price you choose multiplied by 100. So in this case, you need to have at least $1,500 in your accounts portfolio. Now, that $1,500 of cash is going to be secured and used as collateral until expiration date comes by. Now, when expiration comes by, what happens? Well, this is another win-win option strategy. So, come expiration date of March 14th, if this share price right here is trading at any price below the $15 mark right here, well, now we're going to be assigned. But I just told you, this is a win-win option strategy. If you're assigned, you win in two ways. You now get to pick up 100 shares of a stock you wanted in your portfolio in the first place. Instead of $16 per share, you now get to buy it at $15 per share. The other way you win is that you still get to keep your premium. That premium is yours no matter what. Now, the other way this strategy could go, if expiration date on the 14th comes around once again, and this share price stays above the $15 strike price, then you get your $1,500 a collateral that you use. That is now released back into your options portfolio. And what do? Well, now you get to do the exact same strategy over and over again until you're assigned. Now, when do you do either of these two strategies? Well, this one, you do it if you do not own the shares right now and you're trying to get the share at a better price. The previous one, the covered call, you do it if you already own the shares or if you want to do another option strategy. So, in order for you to make weekly income consistently with a small account portfolio, consider these two option strategies, the cash secured put or the covered call. Look for stocks that mimic the amount of money you have in your portfolio in order for you to do the trades with those stocks. Now, the bonus I promised you guys for the real investors, here it is. So for that, let's go ahead and just change the stock. We're going to use MU. So MU is going to be Micron Technologies. Now, Micron Technologies, as you can see here, is traded at 92.5. And I know what you're saying. That's a huge difference from 15.96 per share to 92.5. But I did tell you this is going to be a bonus, so bear with me. So let's go ahead to trade MU options. Let's open up that option chain. Now we're going to go to buy or we're going to go to. So now let's go ahead and choose our strike date. And for that, we're going to go way out. And let's settle for the December 19th, which gives us 285 days to expiration. And now we're going to go ahead and choose our strike price. Our strike price, we're going to choose below the current share price. And I will explain to you why that is so in just a bit. So the current share price, I did mention earlier, is 92.75. And now we're going to choose a strike price. Let's go with the $80 strike price right here. Now, with the $80 strike price right here, we're going to have to pay for this option strategy. Now, the amount we're going to have to pay is 25.15 or $2,515. This new option strategy is known as a long call or a leaps option. Now, why would you want to pick up a leaps option? Well, there's a couple of reasons. So, reason number one, you want to trade this stock, but you cannot afford to trade it because the price point is way too high. So, what you do, you use this option strategy in order for you to control 100 shares at a much less price than what you'd have to pay if you bought it outright. Remember, when I started the video, I did tell you there's two ways in which you could do the covered call. You either need to own the shares or be able to control the shares. And this right here is how you're able to control the shares. Now, let me bring to your attention a couple of very, very important factors. So, factor number one, 104.28. This is going to represent your break even. As you can see here, the break even to the top. And factor number two, your delta. Your delta right here is 0.73. We're going to explain this later on when we go ahead and sell the covered calls. So now we're going to go back and we're going to be selling the exact same covered calls. Let's go to sell and call. And remember, I did promise you this video is about making weekly income. So once again, we're going to use the next weekly date, which is March 14th. And now we're going to go ahead and we're going to choose our strike price. This is where things get a bit ticklish. So the strike price I'm going to be going with is the $105 strike price. Why am I using the $105 strike price? Well, I just showed you the break-even price. The break-even price was $104.28. So what Robinhood just tell you is that you could sell a covered call at any price above this and you should be fine no matter how the trade goes. Hence, I chose the $105 strike price. Now, with the $105 strike price, I'm going to still be receiving some kind of premium. The premium I'm going to be receiving is going to be $20, or in the option world, it's going to be 20 cents. Once again, this is a covered call, but this covered call is based off of controlling 100 shares, as opposed to what we do in the first half of the video, which we actually own 100 shares. Now, how does this trade work out come expiration? Come expiration date of March 14th. Remember, this is just 1 week. If the share price moves from 92.75 to $105, then now we're going to lose our leaps option. The leaps option is the option that we bought in order to control 100 shares. So losing it is not a bad thing. This is another win-win option strategy, and this is one of the option strategies I use the most in my portfolio. So here's what happened. If come expiration date, you lose your leaps option and now you're forced to sell at 105, this is what happens. You're going to get what's known as stock appreciation, or what I like to call on this channel, investment gains. So now you're going to receive the difference between 105 and you're going to subtract the, let's round it off to $93, what you paid per share, 92.75, $93. You're going to subtract that from 105. That's going to give you $12. Remember, we're still dealing with options. So each option contract contains 100 shares. You're going to multiply that $12 you receive, multiply that by 100, and that should give you $1,200. That is not all your gain. Remember, I did show you that tidbit, right, about the delta being 0.73. You now multiplied that $1,200 by 0.73 or 73%, and that's going to give you $876. Now, that is your investment gains or your stock appreciation, but it does not stop there. It keeps getting better. You also need to add the $20 that you received as premium. So your overall gain that can be made on this trade for just 5 days only should be $896. Let's round it up to $900 on just one trade in just 1 week. So by using leverage or using the leaps option, you're able to stand to gain a lot more than if you were to do the first two strategies, which I showed you at the first half of this video. Now, it does not always work out like that, but let's say it does not work out like this, and come expiration date, this share price here does not hit the 105. That's perfectly fine as well, because now you get to keep your leaps option in your portfolio. Even better, you get to keep selling covered calls every single week and generating income to grow your portfolio. And those right there, investors and future investors, are 3 different option strategies that can be used if you're interested in making weekly income. Now, I personally don't do weekly incomes anymore because I have a way bigger portfolio right now. But if you're trading for a small account portfolio, then I strongly suggest that you consider these option strategies. So let's go over them again. The strategies that can be used if you're interested in making weekly income: the covered call option strategy, the cash secured put option strategy, or the PMCC, known as the poor man's covered call, in which you buy a leaps option in order to control 100 shares of the stock. And then you go ahead and sell covered call against the leaps in your portfolio. Now, if you're interested in learning any of these option strategies, or you have any questions concerning how these are to be done, or any questions on how to choose the stocks, then go ahead and feel free to leave me a comment below. And until the next video, keep pushing your investments and most definitely keep making that weekly income.